Ladies and gentlemen, welcome back to the channel. We have some pretty big news to break to you here in this video. Goldman Sachs has went ahead and raised their 12-month price target on the S&P 500 ahead of Q3 2024 earnings season, which really gets kicked off this week with your major banks, and then over the next couple of weeks starts to ramp up even further. Now, Goldman Sachs expects EPS to grow 11% year over year from 2024 to 2025. Their earlier estimate was a 6% rise in EPS. Now, a 6% rise in EPS would put the 2025 EPS total figure for the S&P at $256 per share. Now, Goldman Sachs is giving markets a 22 times multiple. They say that is a fair value, and that is what their models suggest is a fair value. Well, at $256 per share, that means the S&P is a fair value of about 5,600, about 563 on the SPY, at least by the end of this year. Now, at $268 per share, that means the S&P is a fair value of about 5,900 by the end of this year. Now, Goldman Sachs, they raised their S&P 500 12-month price target to 6,300. That is because they just introduced a 2026 EPS estimate of $288 per share. That is up 7%, and they maintain their long-held full-year 2024 EPS estimate of $241 per share. Now, how they're getting to 6,300 is $288 of EPS times $22 per share, and that brings you to $6,336. So about $633 on the SPY. That would be a potential return from here over the next 12 months of about 10% in markets, which honestly doesn't look that bad. Now, the question really now is, should we expect 11% year over year growth in S&P 500 EPS? It's the toss-up. I mean, maybe not. I think Q3 earnings and the guidance that we start to get for 2025 will be most important to this market. Beyond elections, beyond geopolitical problems, beyond even economic uncertainty, that's going to be the most important thing, is really company earnings. And there is a phenomena I want to just warn you guys about, and nobody's really talking about it. Earnings estimates as high as they are, this is something that needs to be discussed. And that is a potential compression of companies' margins. Okay, so in essence, just the long story short version, when there is high inflation and companies are able to pass on cost, their margins are typically rising. That's typically a margin rising kind of environment. When inflation starts to come down, it becomes harder to pass cost on to consumers. So a lot of companies start to get squeezed on margin. Think about it like this. If you are in a scenario where you either have to raise prices or take a margin hit, well, if people don't respond to you raising prices, if that doesn't boost demand, then you lose out on top line demand, and that hurts your margins even more. So for a lot of companies in a now contracting inflationary environment are just going to opt to take a small margin hit instead of raise prices and then lose out on the top line, sell less product, which will hurt your margins even more. The best way to think about this is like a car factory, okay? A car factory needs to be cranking out each and every single day in many cases, or their margins go to shit quickly. Well, if a car company were to raise prices, great. That if people actually keep buying the same amount of cars, that's awesome. But if people stop buying as many cars and that auto factory slows down and they're not able to produce or don't need to produce as many vehicles, that starts to eat even more negatively affect their margin than just taking what could be a slight margin hit because metal prices went up or it's just something small. So this starts to get complicated into micro economics, but long story short is when inflation goes up, company profit margins tend to go up with it because consumers are willing to pay those higher prices, aka inflation. When you see inflation start to fall, that means people are just not responding to price increases. And companies are not able to raise prices, and it has a net negative effect on companies. Thus, meaning profit margins actually tend to fall during these inflationary booms and busts. So honestly, I don't know if 11% EPS growth is appropriate. The markets as a whole are expecting around 18 to 20% EPS growth for 2025. I think that's on the high end. I think that's a little unrealistic. 11% could be too high as well. Potentially a 6% rise in EPS growth. Their prior target that Goldman Sachs had was a little bit more appropriate, but it's a little early to say. I mean, and that would be a fair value on the S&P 500 of about 5,600 by the end of this year. I do also think the multiple is potentially stretched here. I mean, we were sitting at 22 times multiples at periods during or right before the Rona. We were at about 22 times earnings, but longer term, this is still on the very high end. If you look at the dot-com bubble, for an instance, you hit a high of about 24 times. So you are expensive in this market. And again, recession or not, if it starts to look like we could go into a recession, if the economic data at any point over the next 12 months starts to decline, starts to weaken, then that multiple could come under pressure. As multiples typically do, they fall during recessions. Even during 2008, the multiple on markets went from about 15 times down to about 10 times. That was a 50% reduction in the EPS multiple. And that's where things could get even weirder potentially if the economy does slow down. Because for 2024, if you have $241 of EPS, let's say you come in line with that again, $241 for 2025. There's 0% EPS growth for 2025 because companies' margins are getting hit, the economy is slowing down, people are not spending as much money. Just imagine this with me. But let's say multiples go down to 18 or 19. Let's use 18 because, I mean, the economy's weakening and not a lot of people want to buy stocks anymore. Then you're looking at 433 on the SPY, which would be massive downside from current levels. I mean, this is maybe not the most likely, maybe not the most, unlikely scenario either, if we just want to put it frank. That would be a decline of about 24% for markets. So that's kind of the risk here. If we see the same kind of EPS for 2025 as we do in 2024, meaning you just don't see that much of an increase to profitability, which I really don't think is too far stretched if the economy does weaken. Like if the economy does weaken, I don't think we should expect much EPS growth for next year. But that multiple, that's really going to determine potentially where markets go. But by the end of 2025, we're going to be talking about 2026. And if you say 2026, you could have EPS of 260 times that by, let's say, a 20 times multiple. You're looking at potentially 5,200 by the end of next year. And again, that's in a scenario where there's really not any EPS growth for next year and multiples actually come down, which I don't know if that's realistic or not. But hey, we'll see. And really, markets are going to take their cues from Q3 earnings. If Q3 earnings disappoint, then expectations will fall for 2025. And we will start to get more guidance figures for 2025 as well. This is not the big quarter for that, but you will start to get more guidance for 2025. A lot of companies' fiscal 2025s are also starting in Q3. Now, in other news over this weekend, Israel is preparing for a massive attack on Iran. They say, quote, "The attack on Iran will be serious and significant. We are deep in preparations and are dedicating most of our time to it. It will have consequences for Iran, and they should understand that. We expect significant cooperation in the offensive operation from partner countries in the region," IDF source to the Israeli Army radio. Now, here's the deal when it comes to a potential retaliation from Israel. If Israel does not strike oil capabilities of Iran, I don't think it has much implication for our markets. In other words, if Israel targets anything else, control and command centers, intelligence centers, military infrastructure, markets may actually buy the attack. And if Israel targets oil fields, then markets will sell off. It's kind of as straightforward and simple as that, because we're waiting for the escalation. It comes. Is it as bad as feared? The oil fields is the key, because that has financial repercussions for the United States, for really the world at that point. If oil were to skyrocket and gas becomes more expensive ahead of the holiday, shopping season, that's another unneeded cost that companies would face. But that also really slows down personal economic activity. People tend to just do less when gas prices are high. And right now, I think that's the last thing the U.S. economy needs, is another big spike in oil and or gas prices. Now, if you actually look at the S&P 500, we just did something that we did back here on September 11th that did, in fact, cause almost a 7% rally to the upside. And that is this Wyckoff wick here, okay? This was a great sign, okay? Let me explain how this works. So essentially what happened is on Friday, you came down in the beginning of trading, you hit these lows around 568, and then you bounced aggressively, okay? When you get these kind of wicks that have a very long, wick on the downside, and then you close towards the upside, that is normally a very good sign for markets. That means the sellers got exhausted and the buyers took over, and you closed near the high of the day. That tends to lead to a further continuation rally to the upside. So I would actually be surprised if we don't hit new all-time highs by next week. I mean, you would really have to see, I think, Israel strike the oil capabilities of Iran to probably derail this market at this point, considering that blowout jobs report really pushed back on the hard landing. Now, starting this week as well, you get a lot more earnings. Tuesday pre-market, you have Pepsi that reports. Wednesday pre-market, Helen of Troy, a couple other companies. Thursday pre-market, Tilray, Delta, Domino's, and Thursday and after hours, Here Test Systems, one of those AI adjacent names. Friday is really your big day. You have JP Morgan, Wells Fargo, BlackRock, BNY, and Bank 7. The banks could be important because they will tell us more about the consumer and about people's spending habits as of now. The banks are going to tell us if people are slowing down more definitively. Now, it's the following week where you get even more banks, and you will start to get some tech names like Tesla or Netflix that will report earnings also. Now, let's briefly look at the economic calendar for next week. And you really don't have anything on Monday. You don't really have anything on Tuesday. A couple Fed speakers on Monday and Tuesday. Wednesday, you have a bunch of Fed speakers. You will get the FOMC minutes, but that's backwards looking. That's kind of a transcript, if you will. Not exactly a transcript, but basically of the last Fed meeting. So a summary, if you will, of the last Fed meeting. That's on Wednesday. Doesn't tend to move the markets. On Thursday, you have core CPI month over month, year over year, and headline month over month and year over year. As long as inflation does not go up, I really don't think that's a catalyst at this point. Yes, could lower inflation cause the Fed to cut rates more? Yes, but at the same time, lower inflation tends to mean the economy slowing down as well. So it's a fine line between, too much disinflation and just enough disinflation. Now, if inflation goes up again, then obviously that would be a bigger problem. Initial jobless claims may be the biggest catalyst on Thursday, believe that or not. We're expecting 223,000 weekly initial jobless claims. If you come in higher than that, that's kind of going to be something the markets are fearful about. On Friday, you get PPI month over month and Michigan consumer sentiment, 5-year and 1-year inflation expectations, consumer expectations, current conditions, and business outlook. So yeah, not a huge week next week for economic data. As long as CPI does not come in high, then I think it's all going to be about the geopolitical situation going on in Israel. There's a lot of rumors that Israel could attack back on October 7th because that would mark the 1-year anniversary. It'd be symbolic. Keep in mind, for us in the US, the 7th is Monday, but for them over in the Middle East, Monday is actually Sunday. So it would be Sunday that you could potentially see some kind of strike back towards Iran. With that said, markets are sitting on the edge of extreme greed, coming in with a rating of 74. What's actually very interesting about this market as well, so many people are bullish, and even with the blowout jobs report that we had and the rally throughout really the day on Friday, you've seen the VIX just still holding at 19.21. You were only down 6.25%. This shows that there's still a lot of fear out there. There's still a lot of people that have puts and want to buy puts. And this is something that Tom Lee has recently pointed out to say, this is a troubling sign if so many people want that downside protection still. The Atlanta Fed GDP Now tracker is estimating Q3 GDP at 2.5%. The percent of stocks trading above their 50-day moving average on Friday hit 59.62%. About 6% of stocks broke above their 50-day moving average, so it was a pretty good day on Friday. And your latest investor sentiment survey shows bullish investors at 45.5%, neutral investors at 27.3%, and bearish investors at 27.3% as well. So with that said, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.